And we'll go ahead and pass it off. I'll get it in presentation mode for you guys. There you go.
I don't think I need that.
No,
Okay.
yeah, people online.
Just for everyone here, just so it looks like from what I've heard and seen, pretty much everyone here is either a real estate agent or an investor.
Yeah, how many agents are there?
Investors, same thing, kind of. And the guys in the back. Are you homeowners or looking to purchase in the near future?
Well, I'm actually looking to purchase where I rent right now, but I'm here for every.
Okay. So I'll start off a little bit, just a kind of a backstory of me. My name is Ron Filkins. I'm with Change Home Mortgage. I'm the consumer direct manager. I've been in lending, I'm going on 20 years, and I've been with this company almost 2.5 years. I was with one company prior to that for 17 years. I never expected to leave. I was happy where I was at. I was actually the vice president of the company when I resigned. I left there, and we were a broker at the time. I left there because I'd seen the writing on the wall, what was happening, what Change Home Mortgage was. And I had a real insight on it because my major investor, his brother owns Change Home Mortgage. So I really kind of knew what was going on. And it was a tough decision for me to really make to come over here. But it's the smartest decision I've ever made because of our portfolio products. Martin here, he actually runs all of our portfolio products. Now for the realtors in here, or if there's any loan officers, one of the things that Martin also does, especially for the realtors in here, if you want to put on presentations, something similar to this, if you give him enough time ahead, he can come in on a Zoom or maybe even be in person. He's very, very generous with his time, but I'm so happy to have him here because he knows these products inside and out. I did put together some things in the folders in there. Really, it's really going to pertain to the guys in the back because all the realtors will know this. I put in just some, because he's going to talk about the non-QM stuff and our portfolio stuff. We are a full service lender. We are a seller servicer. There's pretty much no product that I can think of that we don't offer or don't have. Some of the things that I put in there are for down payment assistance stuff. There was a fairly new change where it's with Cal HFA, it's a state program where your down payment assistance is actually forgiven if you stay in the property for 5 years. They had things like that in the past. Some of the realtors will probably remember things similar to that. That's something that's new. For anyone else that's not familiar with it, I put in some information there with one that's called GSFA. It's just another type of down payment assistance that it's not quite as stringent on the debt to income ratios. So each product's going to be a little bit different. And if there's something that's going to work for you guys that are looking to purchase, I'd like to maybe talk a little bit about that one-on-one instead of kind of in a just a general, so to speak. But I guess mainly for that, I'm going to turn it over to him. This is really what we're here for. These products, I'm telling you, you're going to see why I left the company that I did to come here. So, Martin, there you go, sir.
How's everybody? Good? Show of hands, how many people are familiar with the non-QM market? Not at all. One realtor. Great. So this should be very informative for you. Non-QM, for all intents and purposes, we call them non-traditional loans. So anything that falls under a government-sponsored enterprise, Fannie Mae, Freddie Mac, Ginnie Mae, or FHA, USDA, and VA, those are all government-sponsored programs and products. Non-QM or non-traditional lending falls outside of that and outside of a lot of the rules that regulate those government loans. Now, I'm sure everybody remembers 2007, 2008, what we all went through there. As a result of that, there was an act called the Dodd-Frank Act that was instituted, which sought to regulate how we qualify borrowers. The non-QM market itself is still fairly tied directly to those rules. However, I'm going to get into a couple of things that separate us from even that group because of some of the things that we've done as a company to get certified for. Because we have how many people on Zoom?
Oh, we got about 4 people on Zoom.
Okay, so what I'd like to do, normally when I do a Zoom call or a live call, I let people ask questions as we go, but because we have such a big group, we'll wait till the end. There's just the last slide is Q&A anyway, and so we'll do that. As far as change home mortgage, we are certified as a CDFI by the Department of Treasury. I'll get into the CDFI in a little bit, but the CDFI acronym stands for Community Development Financial Institution. We were founded in 1994 and we're licensed in 47 states, including the District of Columbia, which many of you know does not have statehood quite yet. Everything that we trade on the capital markets trades at an investment grade of an A rate by Egan and Jones. That's important because in the non-traditional space, most of the time, those securities aren't even traded on the open market. They're privately held, they're bought by investors, and then they're serviced by those investors. We've spent a lot of effort and energy in securitizing those assets, which means that we're expanding our ability to lend more. And we're kind of more legitimizing, if you will, the non-QM space. So that's a really big deal. To date, we've probably securitized roughly about $1 billion worth of those assets. And we are the largest CDFI in the country. As Ron said, we're approved seller servicer of Fannie, Freddie, and Ginnie, FHA, VA, USDA. We are also direct lenders on. And then we're going to talk about our portfolio programs, which includes this list here. But just know that you engage with Ron or any of our other originators, you may have a deal that comes to you that's maybe outside of the state where Ron might be licensed. He can make a referral internally and still maintain his relationship with you and your client in order to affect that transaction that's out of state. That's something that not a lot of lenders do. A lot of lenders force you to make that referral and then say goodbye. But we think the continuity of the relationship is one of the most important things that we have in the transaction. I think our realtors would agree with that. All right, so a little more on the CDFI, or Community Development Financial Institution. In 1994 as well, the Department of Treasury created this platform. And it initially was designed for financial institutions to somewhat level the playing field for members of our communities who are quote unquote underserved and underbanked. Underserved and underbanked traditionally has run along socioeconomic and ethnic lines. So Hispanics and African Americans especially historically have been seen at a higher rate of discrimination in housing especially, and also in general lending products than most other classes. So the CDFI targets those two groups of individuals specifically for some of the benefits. Also, properties that are located in low to moderate income census areas are targets for CDFI. And we've got a specific benefit that we extend to borrowers and properties located within those areas or that meet the target of the CDFI. So it was created in '94. The most important part for us is that it exempts us from certain portions of the Dodd-Frank Act that I mentioned before, most notably the ability to repay rule. The ability to repay rule in general terms means that you are required to generate a debt to income ratio in order to qualify a borrower on a transaction. With our exemption, we do not have to generate a debt to income ratio on any product that we design that we deem to be meeting our risk profile. In addition to the ATR rule, we are exempt from certain documentation requirements in Appendix Q. And what you'll see in some of these products that we have, we've used that to expand the footprint and available lending to members of our community who are, again, underserved and underbanked. When Dodd-Frank was enacted, Jamie Dimon from Wall Street came on and was quoted as saying that it essentially pushed out $1 trillion worth of opportunity in the market. That was back in 2012. Fast forward 10 or 11 years later, that $1 trillion is probably more like 1.2 or 1.3 trillion with a T, which means that we have a vast area that we can lend in where most people are not able to. So we're very excited about that. So what is a non-traditional lending platform? Who does it benefit, and how does it seek to expand opportunity in those areas? This is a partial list of the people that come through our door every day. But I mean, it's kind of a no-brainer, right? A lot of these products don't require a traditional debt to income ratio to be calculated. So your self-employed small business owner, even medium-sized business owner, for example, they fall under that category of high Schedule C deductions, realtors as well. You have to run your business. For everything that you write up on your Schedule C, you're affecting your net income that we need to use to qualify you. So you've essentially pushed yourself out of a traditional market. And without having a non-traditional lender, you really are kind of left to hard money if you can get one. But there's other aspects, volatile or irregular employment. Anyone heard of COVID lately?
No.
No,
Can you guys
not at
turn
all,
off the
right?
subtitle on the pop-up on the PowerPoint presentation?
Tom, you guys can't see it?
No, there's a pop-up on it. Yeah, if you can turn that on or turn it off. Thank you.
Okay, got it.
So volatile or irregular employment are people affected by COVID. As you know, many self-employed people had to close their business and become wage earners again, or maybe for the first time. And in traditional terms, you have to have 2 years of self-employment in order to qualify for a traditional mortgage. Well, with our platform, you don't have to have 2 years of self-employment to qualify. In some cases, we don't track your employment at all. Gig workers, real estate investors, owners of cash businesses. We have 2 products that people in the cannabis industry can qualify for a home loan. And I'm not sure if you understand, though, that you can't go traditional because the federal government does not recognize cannabis as a legitimate industry.
Yeah.
And so you can't get an insured mortgage by the federal government. And on and on. So again, this is a partial list of the people that we see come through our door every single day of the week. And we fund roughly, even in a market like this, we fund roughly about $90 to $100 million a month in a down market, and about a quarter of $1 billion a month in a regular or up market, just of the non-traditional lending products, not to mention our traditional. So we're going to dive into the products. I'm going to start with a limited income product that we have called Alternative Documentation, or AltDoc. Basically, this is known in some circles as your self-employment loan. Why? We only look back 12 months for income history. We look back for a self-employed borrower, we look back 18 months. So for a 12-month history, we have multiple options for documentation. The most popular are the 12-month bank statement options. So essentially, you can give us 12 months of the most recent bank statements. We only require the first page of the bank statement, not all pages, which is one of those documentation options that we have because we're a CDFI. If you go to another bank statement lender or AltDoc lender, they're going to require all pages. We only require the first page for every month. You give us those 12 pages, we're going to take your deposits and average them over those 12 months. We're going to use that as your income to generate a debt to income ratio. Now, if they're business bank statements, then you have to be self-employed with 18 months of self-employment history, not 24. But if they're personal bank statements, we don't validate employment at all. So it could be, and one of the benefits of that, anybody hear of DoorDash or Uber or some of the side hustles that people have? Well, you have a lot of people who do whatever they do for a living, then they have these side hustles, and believe it or not, sometimes it's hard to document that income. And frankly, they're writing off their fuel and some other things in order to take full benefit. But if they flow everything into their personal bank statements, we'll take those deposits that they do every month and use that as their income without validating what they do on their primary or side hustle. Huge benefit. Huge benefit. Also, there are 4 other documentation options: 1-year W-2, 1-year 1099 for independent contractors, and a 1-year tax return for a self-employed borrower. We can go as high as $4 million on a loan amount for this particular product, and as low as 100,000. With a minimum FICO score of 660, and our loan to value caps out at 80% loan to value for purchase rate and term, 75% for cash out. Now, when the market calms down and we see that Fed rate go down and things from a risk perspective get into a better light, you'll see these LTVs go back up to 85 or 90%, but currently we're 80%. This is available for primary, second home, and investment properties up to 4 units. Now, we just turned on the investment property feature, and I will tell you that the spike that we've seen in this documentation type has been pretty special. And I have to track that every day, so I know exactly what it looks like. We also allow interest only to be added to any of these loans. So for those of you not familiar with interest only, basically interest only option allows you to just calculate the interest, taxes, and insurance and association fees if they're applicable to generate a debt to income ratio, and not the principal payment on top of that. So it gives much more borrowing power or buying power to a client. We have multiple terms. So we have a 1-year ARM, a 5-year ARM, a 7-year ARM, and a 10-year ARM or adjustable rate mortgage, and a 30-year fixed. And then every product has a reserve requirement. This particular product requires 6 months reserves to $2 million loan amount, 12 months reserves above the $2 million loan amount. And then lastly, we have a debt consolidation feature that allows you to pay off debt through closing, as long as you don't get any cash in hand, and we treat it as a rate and term refinance. This is kind of what the loan to values and credit scores break out as. I'm not going to go through the grid. You all can see it. I do want to bring your attention down to the last bullet on the left-hand side. It says CDFI fee benefit for any client or borrower that meets one of those CDFI targets I mentioned. So Hispanic, African-American, or the properties located in a low to moderate income census tract, we will credit our underwriting fee back to the borrower at closing. Now, before you think that low to moderate income is not where you do your business in, I've got news for you. The census tract lines don't get redrawn very often, if at all. There are plenty of neighborhoods in Southern California, Orange County, and LA in particular, that are still designated low to moderate income, where there are $1 million properties. You can call it gentrification, you can call it whatever you want. But the fact of the matter is that those census tract lines have not been redrawn in several decades. And we don't mince meat. If it says it's in the low to moderate income census tract area, we have software to track that, then it gets the benefit of the fee being credited at closing. I do like to highlight one of our more popular products that we have and created, our 1-year ARM. It is a 1-year ARM with a 6-month adjustable period. For all doc, the rate is fixed at 6.99% for the first year. Now, your average all doc loan will typically price out somewhere between 7.5 and 8.25. So this is a really special product, especially in a market like this. And again, we will credit that underwriting fee at closing. Any of these adjustments affected by FICO score, LTV, et cetera, are to the cost of the loan, not to the rate. All right. Now we're going to get into something that, if that didn't get your attention this well, community mortgage. It is not a down payment assistance program. It is not a grant. It is actually a product that we developed because we're CDFI. So remember when I said we're not held to the HER rule? We're exempt from that. This is the direct byproduct of that. It's a true no income verified asset product, or NIVA. So no income or employment are determined or established on the loan application, none whatsoever. We're underwriting to the credit profile of the borrower, the assets of the borrower, and the integrity of the collateral or the property. Minimum FICO is 640 on a purchase, 660 on a cash out. LTV up to 80% on a purchase or rate and term, 70% on cash out. The loan amounts range from 100,000 to 3 million. If it's cash out and they have enough equity, the entire 3 million can be cash in hand. You can also use cash out as reserves. Primary and second home only. It has the same term features that AltDoc does, and then interest only is also available at 75% LTV max, except on the 1/6 arm. Now we require 30 days proof of assets for closing across the board. And again, we're only requiring the first page of the bank statement be provided. And some of you might wonder, why is that such a big deal? Primarily because when lenders gather all pages of bank statements, they're required to look at large deposits. So they're required to look at NSF activity. They're required to look at a lot of things that have very little to do with a borrower's ability to repay a loan. By eliminating the pages 2 through 1,000 in some cases, and only focusing on page 1, anything that shows on page 1, we may ask about if it's a significant deposit or activity. If it's not on page 1, we're not asking about it. We're hyper focused on what's in the bank, what came in, what went out, and what's still there. So that really is what indicates a borrower's ability to take care of their responsibility. So reserves range from 12 months to 24 months based on the credit score, as does the LTV is based on the credit profile of the borrower. So, you know, when people first hear about this program, they say no income verified asset, that seems like a lot of risk. But if you really take a look at how we've structured this, our risk profile for a 640 FICO score, for example, requires a 35% down payment. So we're mitigating our risk significantly by doing that. And frankly, whether a person makes $100,000 a month or $10,000 a month or $5,000 a month has very little to do with whether they pay their bills or not. Most high-end surgeons have really terrible credit because they're more focused on saving lives, thank God, than they are about paying their bills. See it every day. And you would think that someone who graduated from Harvard would pay their bills, not all the time. They need assistance for that. For cash out refi, we allow everybody the same access to LTV, but then we do have that reserve requirement all the way down to a 660 FICO. Now, I want to push your attention over the bottom right corner of the screen where you see credit requirements. This loan has saved a lot of deals that otherwise would have gotten canceled, primarily because the credit requirements that we have on BK alone, you would be surprised at how many people come to us. They forget to tell us that they just discharged 2 years ago out of a BK until we run their credit, and then we see it. Or if it's not on credit and we run LexisNexis, and then we find it. That kills an FHA deal, a Fannie deal, a Ginnie deal, or most jumbo deals. But if they have the 20% to put down, let's say they have a 740 FICO, because people who discharge out of bankruptcy have good credit scores sometimes. And they can come up with the 20% either through a gift or through their own assets. They can get this loan, and they can't get any other loan anywhere. So we save a lot of transactions this way. We save multiple transactions that are contingent on each other by having this type of product available.
Okay, interrupt you real quick. This really pertains to this. One of our branches out of El Paso, I think, they're one of the ones early on that said, this community mortgage will never be a big product for us because their loan sizes, sales prices and things like that. How many loans do you think they did community wise last year?
A couple hundred.
Yeah, it was insane. It blows me away how many people qualify and fall into this community mortgage. And when I first heard about it about 5 or 6 years ago, that when it was about to come out, and then for some other reasons it got stopped. But I'm like, no, no one's going to take that loan. If they're get that 20% down, they're going to go this direction or that direction, or whatever it might be. It blows me away how many of these.
So we are in the industry of need more than want. This is a need-based loan. Someone who needs financing who can't qualify traditionally needs a loan like this. And the way that I share this with my clients is this is an interim step to a longer term solution. Once things are more equitable from a credit profile or a market profile standpoint, we'll get you out of this loan. But to get you into the home, this is what's required. And they get it. They get it. Especially in a high, in a low affordability, high value market where the difference between qualifying or not qualifying could be 3% of your debt to income ratio, it makes a difference. This also has the 1-year ARM feature, and that rate, remember, on a no income verified asset deal is 7 3/4. Again, a very competitive rate. As what is Fannie trading at today?
I actually priced out a purchase with a good credit score. I think it was 6 1/4 this morning, at 3% down.
Full document.
First central bar.
So you kind of see why we're excited about what we have going on.
So an example, 6 1/4 that you did, 700 FICO would be a 7 1/4.
Oh, no, so this morning I priced out a purchase for first time home buyer, 3% down on I think it was a Freddie product. It was 6 1/4 was the rate, compared to, this is a no income loan, no income, no employment.
Yeah.
7.75. I mean, we're literally, there's nothing on the application except your name, your social and your address.
I didn't see that left part, so.
Yeah.
Okay.
So, I like to show real life examples, right? This is a real life example of someone who came to us, needed to effect a transaction and virtually ran up against every roadblock other than community mortgage. So Isaac, who's a professional real estate investor and has multiple property ownership, was selling his primary residence to have enough assets to go buy more rental property, but then he needed another primary home. But you can imagine what his tax returns look like.
Yeah.
Right? And by the time you get through all of his schedules, he probably makes, 5 figures a year. Well, to buy a $1.25 million home, that's not going to cut it, is it? So we put him into the 1.6 ARM at 7 3/4 rate with a 744 FICO, and he put 30% down. And he was able to close on his home loan. We close most of our loans, whether they're traditional or non-traditional, in 28 days. These loans, because they're much easier to get through from an underwriting perspective, can close in as little as 20 days. And we don't really have to step on the gas in order to do that. We're very efficient on the backside. So that's just one example of how the community mortgage fits in. So those are primarily primary and second home products, with the exception of the investment option that we just brought in on alt doc. We're going to go to investment properties now. The investor debt service coverage ratio, or DSCR, is also a no income verified asset option. Debt service coverage ratio is similar to what you would do if you're doing commercial property, right? We're looking at the gross rents, comparing it to the fully amortized payment, including interest, taxes, insurance, and association fees. Or if interest only is applied, interest, taxes, insurance, and association fees. No income, no employment is established. So with a minimum FICO of 680, you can buy, refi, or cash out. And then our DSCR ratios are as follows. If the rents are 3/4 to 99.9% of the payment, then it falls under this first bullet or of 75 to 99.9% DSCR with a max LTV of 65%. If the rents are equal to or greater than the fully amortized payment, then the second bullet is where it falls up to 75% for purchase rate and term on 100% or better DSCR ratio. All cash out is capped at 65% LTV. Now, you can't be a first-time home buyer with this product, but you can be a first-time investor. And this is a great way for first-time investors to get in. This is the only product that we have other than the alt-doc investment and the foreign national where a prepayment penalty is mandatory of 1 year. Now, you can go as high as a 3-year prepay and improve the interest rate by 7/8 of a percentage point. Anyone not know what a prepayment penalty is? All right. You can also invest in an LLC up to 4 members. Cash out can be used as reserves. This next bullet is something that really does help save a lot of deals. Fannie and Freddie have a limit on total number of finance properties of 10, including the subject. We allow you to have as many as 20 finance properties, including the subject, on our non-traditional platform. In addition, we can do 10 individual loans for any one client for a total unpaid principal balance aggregate of $10 million. So if you're a professional investor in the room and you have your eyes set on 5 or 8 properties and you like any of these programs, we can do all 5 or 8 properties with you so long as the total balance that we hold with you is not more than $10 million. And again, the CDFI benefit applies to this product as well.
So in this program, are these 30-year fixed arms? What are these?
5, 7, 10-year arms and 30-year fixed.
Okay.
And that's across the board of everything with the exception of alt doc community, where we add on the 1-year arm.
Okay.
Yeah, the most popular term we have right now outside of the 1-year arm, believe it or not, is 30-year fixed.
Yeah. So let's say you got and you're buying a triplex 4-unit and they're empty.
We're going to go off with the
Market rents?
market rents.
Okay.
So if it's already rented and you have lease agreements, we're going to take that figure, we're going to take the market survey, and we're going to take the lower of those 2 numbers. And that's what we're going to base the ratio on, the DSCR on. Nobody ever asked that question. It's great. Foreign national. A true foreign national is someone who lives and works outside of the U.S. borders and buys real estate here for investment purposes. Now, some of those investments could be condos for their kids to go to school that they're ultimately going to rent out later or do Airbnb or whatever. The key is that they are not U.S. based citizens, but they have visa privileges and they have passport privileges here. We don't capture income or employment for obvious reasons. We also don't try to determine a credit score for obvious reasons. We do have a couple of other ways to qualify them. Same DSCR ratios as the investor product. No change to loan to value though. It's just a function of pricing at that point. No cash out, so purchase rate and term only. You can still invest in an LLC. We still have the prepayment penalty requirement. We limit these borrowers to 10 US-based properties, including the subject financed, rather than the 20 for risk purposes. All 10 can be held with us. The assets for the transaction must be in a US-based bank account for at least 30 days prior to closing. In fact, all of our products require that any assets coming from outside the US be seasoned for 30 days prior to closing in a US-based bank account. So instead of the credit report or the employment capture, we're just requiring the funds to be in the US-based bank account for 30 days prior to closing, and one of the three references on your right-hand side, either an attorney reference letter, a bank reference letter, typically from where the money is being held, or a housing reference if they have existing US-based real estate. And that housing reference can be 12 months of payments, it can be 12 months of utility bill payments, just to validate that they have some kind of credit history with those properties. And again, 5, 7, 10-year ARMs with 30-year fixed, and interest only can be applied as well. We did none of these prior to COVID, absolutely zero. Now, I've been here for almost 4 years, and was wondering why we would even have the product if we hadn't done any. And then once COVID became its other self, if you will, we do about 1 or 2 of these a month now. So those of you who are realtors, you have people within your database who have family members outside the US borders. We do a ton of these in El Paso with Juarez right across the river. We do a lot of them in Houston and San Antonio. We do a lot of them in New Mexico. We also do a lot of them in Palm Springs because the Canadian nationals who come down and get out of the cold, they're buying real estate down here. So don't think that you don't have an opportunity to incrementally add some more money to your bottom line with one of these products.
Oh, small words.
Yes, they are.
Sorry, that was a 70% LTV.
70% LTV. You only need 30% down. Now, last of our product offering is a bridge loan. Traditionally, a bridge loan is a loan where you're required to be in a contingent transaction. So you're either selling your property that you're borrowing from, or you're buying a new property, and you're in contract on that property. We don't have those requirements. But a bridge loan is typically used to tap into equity to create a down payment opportunity for a new purchase. With ours, you can use that money in a number of ways. Minimum FICO 660 can be structured as a primary, second home, or investment transaction. Primary second home is 80 LTV max, 75% for investment. It is a first lien product. So people, believe it or not, will refi out of their 3.5% mortgage because they want to go buy a bigger property. But they need the capital or they need the equity that's sitting in that property in order to make that down payment and those closing costs. So they untrap that equity through the bridge loan. Minimum loan amount is $50,000 up to $2 million. It is not a HELOC. It's a 1 or 3 year short-term interest-only loan with a balloon payment at the end. Now, if they get to the end of the term and they haven't done anything to buy a new property or whatever, we can refinance them out of that into another bridge or something else. But again, most importantly, it doesn't require a contingent deal to be in place in order to close the loan. And so many of our clients are now refinancing or either using it as a purchase loan or refinancing, sitting on the money and going out and shopping because we're turning to a buyer's market. So now they have more power to remove contingencies. So that's the product. For the realtors in the room, I do want to point out that we have access to a CRM that has a myriad of content available that we use in partnership with our referral partners, whether it be social media badges on your left-hand side or digitized and physical flyers as you have in those folders. We have a full library that gets updated, I don't know, a couple times a quarter. And I'd like to, I like to have people understand that in a market that we're in today, lots of people have been denied credit when buying a home. They're still going to open houses because mama still wants to buy that home. And papa's just trying to figure out how to pay for it. So when they show up to an open house and they have one of these flyers that says, we understand that you've been denied somewhere else. We have diverse loan programs to meet your needs specifically. They're now a qualified prospect versus just a window shopper. But without these flyers being available, they have no idea what's available to them. So if you're a realtor, I encourage you to partner with us and allow us to participate in those events that you put on. Lastly, I was raised by teachers, so I'm going to give you some homework. These are your next steps as far as I'm concerned. And for the health of your business, I think that, this should resonate with you. You've already been sitting here listening to my monotone voice go on and on. Thank you for not falling asleep. Obviously, you didn't have turkey for dinner. I want you to go back 6 to 12 months of the activity, either personally or professionally, that you've had, where you've run into a roadblock on either an existing pre-qual or on just somebody who came to you, and you pushed them out to your preferred lender and said, go get pre-qualified, and they couldn't. And the reason was number of finance properties. The reason was self-employed income. The reason was changes in work environment. Myriad of reasons why you can't qualify, right? I promise you that if you do this exercise, 6 to 12 months, there are 2 or 3 potential new opportunities that are going to incrementally put money in your pocket and give you referrals because you were able to call them back and say, you know what, I think I have a solution for you. And that's not a sales pitch for me. That's just reality. Anytime that I do this for one of my lending partners in our house here at Change, we come away with 3 or 4 referrals. Because these products are not just unique, but they answer a lot of questions for a lot of people, especially in the market that we're in. So think about it, take your notes. Ron has the business cards. Go through the exercise this weekend and really think about all those folks that you've talked to over the course of the last 12 months, that there's a handful of them that you may be able to talk to again. Any questions?
Yeah. Off the top of my head, I already have 3.
I saw you writing it down.
So that being said, can I get a copy of this?
Sure.
Because I like, I've been in the car business myself, and so I'm dealing with financing numbers and all that stuff. I like to know exactly what I have. I'll put it on my book. Just like this right now, it's value information. Because I already have a couple people who already know, shit. So it'd be great.
Yeah.
I'll get it over sent to you.
Cool.
Any other questions?
Is there any way around, you know, if the great credit score 20% down?
No, we don't do exceptions on this for obvious reasons.
Okay.
We're already assuming a fairly significant amount of risk by offering no income and whatnot. We are, because the CDFI is a U.S. Department of Treasury platform, we're actually more heavily regulated than your average lender. But that being said, it's important to understand that anything that's primary or second home, you can get a gift for the down payment and closing costs, just not the reserves. And so, trust me, people are out there.
Yeah.
Or we could work on the credit. It's great.
Yeah. And my last, I had 3, I lost money.
Yeah, there's a problem.
Oh, that too, but no. So I just share the story. I've been helping my buddy, he's licensed, doesn't do many deals, and got a gift from Canada, 700,000 down, 1.69, and they offered it, appraisal 1.8. And I'm just helping him, a good buddy of mine, and he calls me, I had to help him write the contract, negotiate. But he calls and he's like, what do I do? I'm not getting my loan. Because I've had a second job, it's only been a year, you know, it's like this and that, and, it's just happened, and, putting 700 grand down, half down basically, and, you know, they couldn't do the loan, couldn't do the, trying to do FHA, all this stuff, and I said, well, man, let me make some calls, and before I could even do that, he's like, oh, no, we got it, we paid another 40 grand to buy the rate down to do that, and I'm like, I don't even know if that's worth it, because it's another year they can use that income and refi out of it. So my question is, if we do have a fire like that, which happens quite often, how long does it take if you can get their financials in, bank statements to close?
Anywhere between 20 and 28 days.
The appraisal is one of the things that is one of our biggest issues. So when it comes to like programs like this, because we don't have to order transcripts, we don't have to do BOEs, so we're not getting, I mean, we have to obviously validate where the down payment's coming from. So the bank statements are really the major product, and without us doing anything, and he's being a little conservative on 28 days, but if I need to get it closed quicker and I have the appraisal, we can get it done pretty damn fast, because we don't do any of those verifications.
Use that other appraisal?
Not on these products, we can.
Well, I've been able to before.
You will not be able to do it now.
So, so with that said, then I'll order the appraisal, I'll pay for the appraisal up front. Generally what I do on things like that, because I have been the emergency lender in a lot of these situations, I'll pay for the moment I get the contract, I'll pay for the appraisal immediately, so they don't have to, we don't have to wait for disclosure to be signed. So at least I'll get the appraisal ordered ASAP, and then get the disclosures out that day or maybe the next day, and then get escrow, because I usually like to wait for escrow information, so I don't need what's called smart fees. So I actually get the true escrow fees. Yeah, I mean, at the end of the day, I mean, I've seen things go really, really fast. I've, you know, on average, you know, we're not missing our closing dates, especially on computer stuff. Like if I can only do these the rest of my career, that's all I care about.
Yeah, this guy is in the cannabis industry too, so he had those, I mean, he could have totally done this, just to pay 40 grand to buy an eighth of a point or whatever it was. You know, I'm like, holy cow, like, I think there could have been another idea, you know.
Yeah.
And the other thing too, and what I kind of like about this is, so we're wholesale and retail. We work in the retail division, and we offer these products on our wholesale side, but we're a little bit different than any other bank, where we won't allow a broker to have our product and us run up against our own product and get beat.
Yeah.
So that's one of the things I thought was really cool, and that was another selling point for me to come over here.
Yeah.
So it's
I got another commercial guy, speaking of the commercial stuff too, he's looking at this $5 million commercial property. He's an auto body shop guy. There's his competitors in the space already didn't want to renew, so he's got 5 years on it. So we were already trying to talk owner finance, so he could do the 5 years and get in the SBSA loan, and I believe it's 51%, you know, to occupy. So that's another thing that I'm thinking, maybe he could do this if the owner doesn't want to carry.
well, we don't do
commercial.
Oh, I thought that's, oh, okay.
Up to 4 units. So
Okay.
this is all residential.
Gotcha, okay.
Question on I-10s. I don't know if I saw it, you also.
Not on this platform. We have some outlets that we can do I-10 with.
Hold on.
Yeah.
I'm right across the line.
Yeah, we could do it.
I got, and then as far as the LTV, I got that.
all the information.
Yeah, that's about standard.
What about prepayment penalties? Are there prepayment penalties on these loans?
No, it's all into play.
Well, the owner of the cannabis business or the worker in the cannabis business
Okay.
or who we're targeting. Not the actual cannabis business.
Gotcha.
Right now, I mean, we're just in Humboldt County, so I got some questions.
Is that a question that came up?
Hey, Tom, if, go ahead and text me your question. It's hard to hear you with the sound.
Are there any prepayment penalties on the loan?
Only on the investment property products, not on the primary second home.
Got it. Thank you.
You're welcome.
Okay.
Yeah, there was a reason why I brought Mark. He knows these products inside and out. I love him, and again, for you realtors, telling you, he is very, very generous from the time. We've got to give us a little bit of a heads up. If he's gonna do, well, probably a lot of a heads up. especially, with your schedule right now, but.
Well, right now it's a little tough. I referee college basketball as well. So, right now is a tough time of year for me, to just do something on a moment's notice. But it'll all wrap up here middle of March for me. So, anytime after, say, my birthday, so anytime after the second week of March, I'm wide open.
You guys have a local officer?
We do.
Yeah.
Anaheim Hills is our corporate office. And then we've got branches in Rancho, Beverly Hills, or down here. We have a lot of people.
What particular office have you?
Yeah.
Yeah. And home. I do a lot of this stuff.
So I got one. So you mentioned verified assets on the community mortgage. What are we all looking at? It's verified, obviously cash, of course.
Great question. So, depending on the product, we range anywhere from 70 to 100% of stocks, bonds, mutual funds, invested retirement, including 401k.
So.
So on
70
community, it would
70
be
to
100.
70 to 100. So there's different assets that you'll value at different.
So on alt doc, for example, you get 80% value of your stocks, bonds, mutual funds, and 401k.
Okay.
On community, you get 100% value towards your reserve requirement. And again, if you have interest only turned on, then we're only calculating the interest only payment towards the reserve requirement.
Right.
So we give a little bit more spread.
Stretch it.
Yeah, it stretches the money out quite a bit.
What were the terms on it? Just something? Or the length?
So if it's on the 5, 7, or 10-year arm, it's for the fixed period of the arm.
Okay.
If it's on the 30-year fix, it's the first 10 years of the 30-year, and then it'll recast after that. 99% of the people that hold a loan only hold it for anywhere between 5 and 7 years, and then they're refining out of it anyway. And in a market like this, they're refining sooner rather than later. Once things calm down, once it's curved,
Yeah.
that's making more sense.
Right, exactly.
It's amazing at times when there's fires and happening, sometimes there's just like not a fast enough solution. You know, so this is there's a difference.
Well, not only that, but one of the things that I love about us is we're truly all in-house. So we're not the only lender that does DSCR. You know, we are the only one that does community, but like some of the industrial products or your foreign national stuff. But I was a broker for 17 years and it's tough, especially right now. It's even worse now because everyone is, you know, they're cut so many people. So getting answers and getting things into underwriting as a broker. I mean,
Snowstorms, back east.
yeah, I'm still very much in touch with my previous company. I mean, I love, except that the CEO, he's still with the other company, this by the time. But with us, it's completely different. You know,
It's 100% control over our environment. And, you know, let's be honest, things happen. You know, probably the thing that slows us down the most are borrowers not getting us the items that we need in order to close. But that's everywhere, right? Things only get urgent when you get closer to your close of escrow date.
There's ever rebranding in the future, control home mortgage, not a bad name.
like, you're saying people be like, oh, we're mortgage banker.
Well, that's the
Your
issue.
name's on the one.
That's what the issue with this guy is, and you know, I know they can shop rates and stuff, but they don't know their underwriting, so when they're packaging a loan, like, they should have known this.
Yeah.
He's shopping for a month and then he finds a house and then 2.5 weeks in, and then they say he can't do it, it's like. Huh?
Yeah, you know, and Ron has the ability to pick up the phone or instant message the underwriter on his file. And that is worth its weight in gold.
Or the underwriting,
You know,
Margo, I'm
and
talking.
we, you know, we have loan officer assistants who are pretty much underwriters themselves. So very little goes, if anything, goes into the machine that doesn't come out the other end the way we expect it to.
Right.
Yeah, you know, and I mean, the last thing I'll say, from a corporate, perspective is the founder of our company and everybody downstream, we're all mortgage people. He was a loan officer before he created the company. So was his partner, you know, they worked together. Probably the architect really of our ops process was a processor to start. So these aren't you know, we're not working for a bunch of hedge fund guys who came in and decided they're gonna throw their money around in the housing industry. These are all bootstrapped folks who have done really well over the last 20 or 30 years, as we all have, who really understand what it means to build a mortgage outfit, not just, you know, not a money printer. So, and I think that for me, that's why I'm here. You know, I was asked to come here by our mutual boss, and having worked with her for, I don't know, a dozen years. And you know, once I met the people, it was like, okay, that makes sense. Right. Any other questions?
So on some of the, like the rental loans, let's say, I don't know, if you got, you know, slamming credit, 750 right now, you know, traditional 30-year fix, you're probably at, I don't know, 6.4, 6.3, maybe. So what's the,
So you're gonna be in the mid to high sevens or low 8s, probably.
okay,
If you put on a 3-year prepay, I'm fairly confident that you'll be in the high 7s. With interest only, that's an add to the rate, so that might cap you right at 8% or so. And you know, the offset of that is that we're not having to stretch your finances or your ability to repay to get you into the market.
Yeah, your regular Fannie Freddie investor stuff right now. I mean, on a situation like that, if it's the same down payment, it might be 5/8 better. Might not even want to be half better
With what fee?
on rate
At
for.
what fee? What would the fee be, the price?
I would have to look. I'm kind of going off the top of my head right now, but I would think it's not going to be that far off. It's pretty amazing.
Yep.
Now, like, don't get me wrong. If we use the community mortgage and you're 640, barely meeting the cut, and we got to close. Yeah, rate's gonna suck.
yeah,
It's gonna be 9.25.
yeah, but no, a lot of those rates didn't sound that bad.
But you can't go anywhere else. If you go hard money, you're paying 12, 13%, 8
Yeah.
points, 5 points.
You're getting
You
killed.
know, yeah, it's, but you have a 780 credit score and you're putting down the minimum, it's still not gonna be that bad. It might be 2 points higher or 2% higher than your regular Fannie Freddie.
Right.
But again, we're talking no income,
Yeah.
no employment. I mean, this is insane. And again, I really, when I first heard about it, I didn't think we'd do that many of them. When I came over here, I would prefer that small line when I would trust not. I mean, they had a escrow.
And you know, we pride ourselves on being mortgage professionals and not just loan officers. And that's where that interim step mindset comes from. You know, we can do whatever you want. We can go full doc all day long. But if you can't get there, we have in-house solutions and as interim solutions to get you in.
Correct.
And then we're going to monitor where we are and where the market is. And when we find an opportunity to give you a more equitable solution, we'll do that.
Right, right.
And I think that's what we should be doing as mortgage professionals.
Absolutely.
You know, the term loan officer kind of makes me cringe anymore. Because I was in wholesale before I started doing this. I met a lot of loan officers that, you know, I didn't really cater to. But the mortgage professionals were far and few between, but they were really good at what they did. And they made a career out of it. So, yeah.
So for back to the rental, so let's say, I know a lot of lenders don't, or even, you know, just properties in general, it's got an ADU, they're still recognizing that as a single family, even though it's basically a 2-unit. So is that to you guys an SFR, or is that a 2-unit?
It is a SFR with an ADU, but we only allow one ADU. A lot of these properties now have multiple ADUs,
Right,
which is
garage
presenting a
conversion.
problem. Yeah.
Okay, so you're gonna count that as 2 on a rental property loan? The main house and then the ADU, so you can see that as.
Correct.
That's what city too, because I'm an appraiser, depends on what city, some cities consider them ADU. Some cities allow that ADU be added to the swim pitch to 12 halls.
Right.
So that was just not.
But if we see it as a separate unit, we're going to treat it as an ADU for lending purposes, for our guidelines.
Like on a condominium or townhome that has the land lease,
Yeah, we don't do any lease land,
I had
on,
a headache with this deal.
they can be headaches. Go out to Palm Springs, you'll find a lot of them, especially with the Indian lease on top of that. You can do them Fannie, I think, right?
I think you have to have a 99-year lease.
For the Indian lease, yeah.
Sometimes they're even buy them out.
Yeah, there's a problem, this land lease is actually, you have to
You
take
buy out, how long?
so it's already coming up, so that's why a lot of it is.
Yeah,
So just take, max you can finance is 10 to 10 years,
The one on Tesla.
yes, on Bear Street.
Oh, yeah. Yeah.
But, hey, it's a feeling to me right now.
We should try that.
Yeah. Dude, I had this
Those are
client
my
that
excellent.
he loves it, he just wants it, he could put like 100 grand down. Crazy.
Yeah, but when you look at the payment, it's just, you guys are fine, you know, it's crazy. At least it's 1,200, 13, 14.
Touchy, fair enough.
Another conversation, over a year.
That's actually, that's a headache.
Yeah.
any other questions?
It's actually-
Any other questions, guys? Cool.
I'm gonna stick around for a little while. I'm just gonna have to take off, so.
Yeah, guys, we always network at the end. This of course always gets recorded to my YouTube. So if you want to go back and watch it, I'll post it there. Other than that, next month I'll be speaking on the financial markets. We're gonna dive into the charts. We're gonna look at the bond market. We were just kind of looking at it at the beginning of the meeting, and of course other assets. I think markets are bottoming. Okay, so I've had the thesis that, risk assets are gonna bottom first, which they kind of have, tech stocks, and then the S&P 500, and then real estate's gonna bottom, right? Because those all move with a big lag. You can't sell real estate really quick, okay? To get on the market, that's why it lags behind. So we're definitely kind of seeing that sign of that U-shaped bottom. We'll kind of dive a little further into that, but that's kind of what I was saying. Cool.
Thank you, Josh.
All right. Everybody online. Thanks, guys. See you next month.
Take time. See you.
Yeah, see you
See you,
Sunday,
Tom.
guys.
All right. Peace.
Yeah, I got your president.